Today we are discussing Meta Platforms, ticker META, otherwise known as Facebook. This has a market cap company of $359 billion, enterprise value of $327 billion, and operates in the interactive media and services segment. So I'll be discussing my thoughts on both the valuation of this company and its business quality over the next few minutes. So we can first see with this enterprise value that they're holding a significant amount of net cash, about $22 billion. That's always nice to see that they're not leveraging up with financial leverage. So they operate in two segments, family of apps and reality labs. For those who don't know, this includes Facebook, Instagram, Messenger, and WhatsApp. The reality labs, of course, is their virtual reality segment, otherwise known as the metaverse that they're working on as well. Beta of 1.31 means they're about 30% more volatile than the average S&P 500. Normally, high volatility is a negative on the potential quality of the business. Let's look at return on invested capital. Now, the first thing I see here is, of course, since they've IPO'd, it looks like in 2010, they have been profitable every single year, which is always a good sign when you have 10 straight years of profitability, maybe 11 straight years of profitability here. Always a good sign. Now, the second thing I noticed with this return on invested capital chart is that they have some really strong numbers on the return on invested capital. Every year since 2016 has been a double-digit year in terms of return on invested capital. Even in 2015, where it was not double digits, it was 9%. So you had almost double digits since 2013. And since 2016, you're basically hovering around 20% plus. Anytime you're talking about 20%, 30% range for return on invested capital, your numbers are quite good. A lot of companies I look at are below the 10% line. Anything below 10 and 20%, anything between 10 to 20 is actually still pretty good. Once you're getting over that 20% number, you're in a very unique range, and that's a very good number for return on invested capital. So very impressive numbers in terms of the quality of the business going on here. The next thing I noticed, though, is that it's not very stable. When you look at this chart, you don't see some sort of stability year over year. You do see pretty steady improvements, which is nice. You're kind of trending upward. And if you're trending upward from 28%, that's a really good starting point to be at. It looks like the peak of your returns is the most recent year. And it's not like it's just a one-time thing. They have some very strong numbers. So very high quality business here in terms of the return on the invested capital. You can see as well that they're hitting that 20% range with their 10-year median returns. The fact that the return on equity and return on invested capital are both 19% is showing you that they're not having to use debt to achieve these returns. This is all achieved from the sheer economics of the business. Likewise, your 10-year median margins are just astronomically high. It's not uncommon that we sometimes see some really high quality companies with a gross profit of 82%. But when you start talking 38%, 39%, 34% margins on EBIT, pre-tax income, and free cash flow, these are world-class numbers. You don't see numbers above 30% like this. This is some of the best in the world type margins. So not only is this a high quality company, you're talking, top clear tier world-class type margins from Facebook here. I still can't get over calling this company Meta Platforms. I'm going to call it Facebook for a lot of the rest of the video. Likewise, so we can see here, of course, high quality business, everything looking good there. And then let's get about valuation. I see a PE of 12 here. This is actually really attractive for a business that is such a high quality business. It is not common that you see a business with these sorts of metrics in the S&P 500 today trading with a PE below 15, let alone a PE below 20 or 30. So the fact that you're paying a PE of 12.5 is actually really attractive as a potential investment for shareholders. I like to buy stocks with a PE of 15 or less. I want to buy a high quality business at 15 or less. And right now, Meta Platforms or Facebook is hitting that metric, so it looks like a very attractive valuation. But on top of that, the growth here is just extremely stupidly high. You're seeing revenue growth of 41%, EPS growth of 47%. These numbers are ridiculous. I mean, and to really get a handle on what this is, you went from $5 billion in revenue in 2012 to $117 billion in revenue in 2021. Now, there's no way this repeats, because this is a 20x increase, which would mean in the next 10 years, you'd have to be at $2 trillion in revenue, which is just not going to happen. But this growth has been amazing. I mean, we're talking in terms of like some of the best 10 years in business history right here to go from 5 billion in revenue to 117 billion in revenue. These sorts of growth rates are amazing, and they have led to very, very strong shareholder returns. You're seeing not only that, but I mean, think about this, $117 billion in revenue going to a $95 billion in gross profit. Just amazing. Very, very good numbers here. Operating profit, 47 billion. Again, these 40% operating margins, very, very good. It's not even, worth analyzing. They went from a 1 penny in EPS to $13 in EPS. So that's over 1,000-fold increase. But even if you just go from 2014, you're talking a 13x in 7 years. If this was repeatable, then you would absolutely want to buy the company at this sort of stock price. So why would it be trading at this price? It's because the business must be expecting either lower returns or declining earnings in the future. Otherwise, you don't trade at a price like this in today's marketplace. But on the pure numbers of what we're looking like in the past, Meta Platforms looks really attractive as a potential investment. And so I'm excited to learn more as I dive into the income statement and balance sheet next. If you're enjoying this video, please hit that like button and don't forget to subscribe. So let's go to the income statement. I just love how I see, these cost of goods sold staying so low. I mean, this is an advertising-based business, so you're not going to have a lot of cost of goods sold. They have increased their SG&A quite significantly. You're going up, 15 times in the SG&A, but your gross profit is up 30 times. So you're still seeing operating leverage here. Just an incredible amount, actually, as your operating profit has gone from 500 million to 35 billion over the course of a decade. Just very good numbers. You can see some of this decline here already as they've had an operating profit, in 2021, 46 billion, but over the trailing 12 months, it looks like it's 35 billion. So they're falling off a little bit. That would explain some of the lower valuation. But the history here is just amazing. Now, you do have some dilution. You've diluted from 2.1 billion shares outstanding to 2.8 billion shares outstanding. That's like an extra 30 to 40% new shares over the course of a decade, which is quite a lot. But when you have growth like this, it's completely irrelevant because you're talking about 3 to 4% dilution year over year, and yet, or 3 to 4% dilution each year. And yet, if you're growing at 40%, who cares about 3 or 4%? It doesn't matter. These are just very, very good growth rates. Even over the last, years worth of profits, when you talk $10 per earning per share, you're still trading at a very attractive 13 PE. So very good numbers there. From a balance sheet perspective, you see all this cash and short-term investments. I mean, $50 billion here, which is very good compared to their overall market cap. You're talking about, 15 to 20% of the market cap in cash and short-term investments. That's a very solid metric. You have no long-term debt. You do have some capital leases of $12 billion, but for the most part, this business is entirely funded with cash exceeding their total liabilities. Total liabilities of 41 billion, and that you have, this $50 billion in cash and short-term investments. That's attractive. You have PP&E of $70 billion, which is significant, but you're earning more than that in gross profit. I mean, you're basically earning a 30%, here's your 30% return on your tangible assets there, which is not that bad at all. I mean, this is amazing, 28% return. So you're seeing that play out in the balance sheet as well. They are having to put a lot of money back into the business, but because of the growth, it's been totally worth it for what you can see as a shareholder. Let's go to the cash flow statement though. You do see the depreciation and amortization growing quite rapidly. I mean, you were depreciating, $1 billion a year. Now you're depreciating $8 billion a year. But compared to these cash flow from operations numbers, these are growing much, much faster than your depreciation and amortization. So you do have these big investments in PP&E, but you are clearly funding that with your cash, and you have plenty of cash and net income left over. The acquisitions are small relative to your cash from operations, which is a really good sign. You have other investments being made here. I don't really know where those play into it, but it could just be, even short-term treasuries could be what they have there. You're starting to see some share buybacks to quite a significant degree. I mean, $44 billion in share buybacks in 2021. That's a significant amount of money now being returned to shareholders as the growth slows down. I like that they're spending money on those share buybacks. You don't have a lot of debt here, which is a very good sign. And of course, this cash from financing is just talking about, of course, your common stock here and the other. So hugely cash flowing business. I mean, $57 billion in cash flow from operations in a single year. I mean, these are just astronomically huge profits. And on a company that's trading at $327 billion in enterprise value, this is extremely attractive. I've not done a lot of deep dives on Facebook before, or Meta, if you want to call it that, because I've, tend to focus on microcap companies. But if you're going to focus on a large cap company, it looks like Meta is very, very attractive. The numbers here are world-class margins, world-class returns on capital, world-class growth, which, again, surely not going to repeat this sort of growth, but you don't need it. I mean, at a PE of 12, you're talking about a business that needs single-digit growth in order to justify its valuation. So if this business simply doesn't decline, you could be very, very attractive. I'm interested. Meta would go on to my watch list, and is probably something I should study more deeply about potential buys in the short term with the sorts of numbers you're seeing here. You'd have to really understand the business, what you think is going to happen in the future. You want to understand, how is social media going to play out in the future? What's the sort of durability of this product? But overall, the numbers here are outstanding and some of the best I've ever reviewed. If you're enjoying this video, hit the like button. Please subscribe. And if you want to check out all the companies I like in the S&P 500, the playlist for my watch list stocks is at the top, which Meta will be joining here shortly. So thank you for listening. And if you want to learn this software that I use, is just quickfs.net. My affiliate link is the first link in the description below. I hope you'll check it out. If you can get a free or paid account, that's a great way to support the channel by signing up through my link. Thank you for listening. And until next time, stop paying fees, start building wealth.